So I wanted to start today about talking about the impact of depreciation differences. And we briefly touched on this when we talked about the disposal of long-lived tangible assets. And we said that depending on whether you depreciate it, straight line method versus units of production versus a declining balance method, you could end up with a gain or loss on disposal because of the depreciation method itself, not necessarily because you use the asset differently. So I wanted to pull this page out of our textbook too, just to kind of just spend a few minutes on how that happens. So it says, assume that Cedar Fair and Six Flags each acquired a new roller coaster at the beginning of the year for $15.5 million. So that's the cost. The two companies estimate that the roller coasters will have the same residual value, $1.5 million, at the end of their 7-year useful lives. So this is a made-up situation. This isn't reality. We're just saying, let's assume both companies buy roller coasters, same price, same residual value, same useful life. However, Cedar Fair is going to use the straight line method of depreciation, and Six Flags is going to use the double declining balance method. Okay. So we take a look here at what the two methods will look like in terms of depreciation expense on the income statement. Cedar Fair is straight line. So remember, for that, we would take the cost of $15.5 million minus the residual value of $1.5 million, and that would give us $14 million. We divide by a 7-year useful life or multiply by 1/7, and we get the same depreciation every year. And every year, as we do that journal entry, we add to the depreciation, accumulated depreciation account, 2,000. With Six Flags, they're going to take the cost minus the accumulated depreciation and multiply by 2 divided by 7. So they're going to start with really high depreciation in their first year. And then in their second year, when they take the cost, 16.5 or 15.5 million, they're going to subtract out the accumulated depreciation and then multiply by 2/7. So each year, as that accumulated depreciation grows and is subtracted from the cost, the expense is going to drop with each and every year. Now we're going to assume that the two companies are going to use this roller coaster in exactly the same way. Same number of customers, same amount of revenue earned by the company. Everything about it is the same, except one uses straight line and one uses the declining balance method. Okay, now let's assume that at the end of year 4, which is right here highlighted in yellow, that both companies sell their roller coasters for $6 million. Okay, so that's the amount of cash received. Remember how we compare the cash received to the book value? Okay, so Cedar Fair is going to get $6 million for something that's worth $7.5 million on their books. So will Cedar Fair have a gain or a loss? They're going to get $6 million for something that's worth $7.5 million on their book.
Oh no, they're losing.
They're losing. Okay. Right, because they're getting less money than it's worth on their books. What if, and we said Six Flags, this is using the exact same roller coaster in the same way, their book value is $4,035,000. So if they get $6 million for that roller coaster, will they have a gain or a loss?
A gain.
A gain. Isn't that weird? Because in both cases, that roller coaster is used exactly the same way, right? Same number of customers, earning the same amount of revenue, and yet because one company uses straight line, they depreciate more slowly. So they have a higher book value than Six Flags, just because Six Flags uses an accelerated method and they depreciate more quickly on their books. So on the income statement, you're going to see a gain for Six Flags and you're going to see a loss for Cedar Fair. So this just points out any gain or loss on disposal on the income statement tells you as much about the method used to depreciate the assets as about the management's ability to successfully negotiate the sale. So it's, enough now, because of learning this information, that when you see a gain or loss on the income statement, you look at the notes to that income statement and see and look at the type of depreciation they use. Because if they had used a different type of depreciation, maybe it would have been a gain instead of a loss. So it's not necessarily the case that they negotiated poorly, like in Cedar Fair's case. They just used a method of depreciation that was slower. These are all the things you got to think about, both as investors and as managers. Look at these different airlines and the useful lives they use. American Airlines depreciates their planes over 30 years, Southwest over 25, Alaska over 20, and Singapore over 15. So Singapore's accumulated their depreciation expense and consequently accumulated depreciation is going to be higher than American Airlines because they've got literally half the useful life that American Airlines has. And so that's why when we look at income statements, a lot of investors and creditors look at the line called EBITDA, earnings before interest, taxes, depreciation, and amortization, because all of those things are management decisions that affect the bottom line, not necessarily the result of operations. Like, for example, the depreciation uses estimates. We don't want to consider those things that aren't a reflection of management's ability to lead the company when we're making an investment decision or a decision whether to grant that company credit. Okay? I just wanted to point this out because it's pretty sophisticated in terms of your ability to understand what those financial statements convey. You're learning some very powerful information gathering techniques with regard to reading financial statements.
Okay. I don't really understand how that happens. How are they one having a gain and the other having a loss?
Because it's just the depreciation method. Straight line, when we calculate straight line, it's the same amount every year. When we calculate double declining balance, it starts out really high just because of the formula. So what it's worth on your books at the same time and point in time is very different just because you used a different formula to calculate depreciation. That's it. And all three methods that you learned are acceptable. So that's why the reader of an income statement needs to look at the notes to understand. If you see a gain or a loss, or even if you just want to understand the book values that you see on the balance sheet, look at the notes to the income statement to see the method of depreciation used for depreciation expense and then for the calculation of the book value on the balance sheet. All that was different there was the method of depreciation, the formula used. One resulted in a gain, the other in a loss. If they had both held them to the ends of their lives, it would have been the same amount of total depreciation. It would have been 14, if you add this up, 14 million here and 14 million here. But when you catch it right in year 4, they're not at the same place in terms of their book value because they use different formulas.
Okay.
Crazy thing, huh?
Yeah.
Okay, now we're going to take a look at 9-6, but instead of using the notes here, I'm just going to go to page 411. If you remember back on day 1, we talked about intangible assets being long-lived assets that have special rights, but they don't have a physical substance. It's not like land or buildings or machinery where they have a physical substance and you can touch them. The existence of these intangible assets is indicated only by legal documents that describe their rights. So examples of these we're going to talk about now are things like patents, trademarks, copyrights, etc. So like long-lived tangible assets, if you pay for an intangible assets, not all of them are paid for, some of them are developed internally. But if you buy a long-lived tangible asset, like if you buy a patent, then whatever you paid for it, including any legal costs or filing costs, should be included in the cost of that asset and debited to that asset. But a lot of these long-lived tangible assets are developed internally. For example, my brother-in-law used to work for Lindy, and he was an engineer, and he developed patents on behalf of Lindy. No, they didn't buy them from my brother-in-law. It was part of his job to develop them. So there's nothing to record in the patent account because it was just have been his payroll. And when a person is working on a patent, and it could be several engineers at the same time, you don't know which one's going to work out and which one isn't. So you can't capitalize or put into an asset account everybody's payroll costs, right? So what we do is when a patent is developed internally, or a copyright, whatever it is, whatever intangible asset it is, if it's developed within the business, we just debit an expense account called research and development. But if you buy a long-lived tangible asset, then you can debit an asset account, okay? A long-lived tangible asset account like patents or copyrights. Okay? And do they wear out? Do they depreciate like long-lived tangible assets like buildings and equipment, machinery? Yeah, they do. Some do, not all do. We're going to talk about the ones that do and the ones that don't in a moment. But the wearing out of a long-lived intangible asset is called amortization. It's the same process as depreciation, except we have a different name for it because it's a different type of asset. So instead of calling it depreciation, we call it amortization. And we use the straight line method only to amortize these long-lived tangible assets. So for example, patents wear out in 20 years. So Apple can make the iPhone for a particular design for 20 years. And once those 20 years are over, anyone can see the plans and make an Apple iPhone to that specific plan. Well, it wouldn't be an Apple, it would be whoever made it, but they could make that same type, just like pharmaceuticals. So 20 years is the maximum time you can hold that patent. So that would amortize. On the other hand, trademarks never wear out. You just keep renewing them. So we wouldn't amortize that. If you paid a marketing company to develop a trademark for you, you put an amount in that trademark account, you debited it for the cost of trademark development, you wouldn't amortize that because they never wear out. It's like the Nike swoosh, right? You just keep using it, and each time it comes ready for is ready to expire, you just file for an extension. So some long-lived tangible assets have a limited life, and if they do, we amortize them, which is like depreciation. If they don't have unlimited life or limited life, if it's unlimited, then we don't amortize them. So amortization is calculated using the straight line method. Intangible assets with a limited life are amortized using the straight line method, and we call it amortization expense and accumulated amortization. That's the account that's credited. See if I have that.
I've seen that choice so many times on the Connect stuff.
Oh, did
now
you?
now I actually know it. Well, like when you're putting the accounts in, like it gives you a choice of like every single title that's possible.
Oh, right.
Yeah.
One of them. Yep. I'm just going to go to the. I'm just packed up here, going to the book, so I can pull out the page. Here we go. Sorry. Okay, so that would be the journal entry that we would do. All we would do is change the word depreciation to amortization. I didn't give you any problems with that. All SUNY cares about is that you're able to recognize intangible assets. And because you have so much else to learn, and this is less common, we aren't, we just want you to know that what intangible assets are, and those that wear out, those that have limited lives, we depreciate them, but instead we call it amortization. That's pretty much it. But let's talk about these different types of long-lived intangible assets. Okay, so again, I pulled out page 411 from my textbook, but you can find your text in Connect, in the Connect folder. It's the first link there. And you could scroll to page 411 if you'd like. So trademarks. Trademarks are a special name, image, or slogan identified with a product or a company, like the name Kleenex. We call those tissues Kleenex, but really Kleenex is a product name, just like Jello, that's a product name. What it is generically is called gelatin, right? So that word Kleenex or Jello, those are trademarks, particular name associated with it. Or we've got the golden arches from McDonald's. You probably are wearing clothes right now that have some type of logo. Maybe it's the Sabres, or maybe it's, I don't know, Adidas, but it's got a name or it's got a symbol that represents that company, right? And those are considered trademarks. Those, as I mentioned, will not be amortized because they don't have a limited life. We can keep renewing those. Copyrights do have a limited life. A copyright gives the owner the exclusive right to publish, use, and sell creations. And it could be a literary creation like a novel, fictional novel, or a biography, some type of written material, music, artistic, so that might be some type of graphic or sculpture, painting.
I actually saw something on TV not too long ago that kind of like ties into this. It was something with like McDonald's when they first started out. And I guess like they had some process in the kitchen that was allowing them, like there was really no fast food back then. And McDonald's was really the first place. And they had like some process that made everything faster in the kitchen. And they were like selling that process for like $900 to whatever restaurant wants to get it. You go to McDonald's, $900, you know how to do it. They teach you how to do it.
That would be an example of a patent, right?
Yeah.
Very good. Yeah, very good. Yeah, that's exactly what we're talking about. Now, when it's a creation, like a dramatic work, a play, whatever it is, music, it's 70 years after the creator's death. So, for example, most of the Beatles songs were acquired by the rights to them, the copyrights to them were acquired by Michael Jackson. And the estate now owns them since Michael Jackson has passed away. So that period goes for 70 years after the author's death. And during that time, if anyone wants to perform a Beatles song, they would have to pay Michael Jackson's estate for the ability to do that. Now, that doesn't mean
would that be 70 years after Michael Jackson or 70
I'm sorry,
years after?
I'm sorry, of the Beatles. I apologize. I said that wrong. After the Beatles, whoever created it, whether
Oh, okay, sorry.
I
you said that
apologize.
Michael Jackson bought them for some
No,
reason.
it's my fault. I'm sorry.
Oh,
I
good.
should have said after the Beatles' death. So whoever authored it. In fact, let me just get another thing from my folder. The Happy Birthday song just came off copyright just a little while ago, relatively 2016. That song, Happy Birthday to You, you probably have never encountered this, but when my kids were small and we take them out to a restaurant for their birthday or whatever, and this restaurant would sing them a song, but it wasn't the Happy Birthday song because they couldn't perform it in public without having to pay royalties for that, and you're constantly singing to people who are celebrating birthdays. So they would make up their own song. So you weren't allowed to sing Happy Birthday to You until 2016 when it came off copyright. It says here, let's see, according to historians, the musical accompaniment to many a cake eating and candle extinguishing was published in England for the first time by Claydon Sonny in 1924. The song had been in print for a dozen years before, but none of those printers thought to copyright it. You have to register copyrights. Of course, once published, royalties were due whenever it was sung in public. So movie makers and radio broadcasters wanting to avoid the fee would sing for He's a Jolly Good Fellow, another favorite birthday anthem. Happy Birthday to You is still copyright. Now this is, back a few years ago. When I pull this out of a calendar, Happy Birthday to You is still copyrighted, but there's a birthday candle light at the end of the tunnel. The current European Union is set to expire at the end of this year, 2016. So from 2016 on, restaurants or whomever, you could sing it, you could put it on an album and not have to pay a cover charge to whoever owned the rights to that song. And that goes for books like your textbook. I can't make copies of the textbook to give them to students because that textbook is copywritten. So that's what prevents that law copyright law prevents people from putting on plays. If your went to high school and the high school put on a play, if the play was copywritten, if it wasn't beyond 70 years after the author's death, then they would have to pay whoever owned the rights to that. And it might not be the author, it might be that they sold the rights to someone else. So since this has a limited life, that would be amortized. Patents are for processes, like the example you gave us about McDonald's. A patent is an exclusive right granted by the federal government to the patent owner that prevents others from using, manufacturing, or selling the patented item for 20 years, and that does include processes as well. You'll notice that with drug manufacturers, I forgot who makes Prilosec and Nexium, but Prilosec is now called generically omeprazole. A lot of people use it for GERD, gastrointestinal reflux disorder. And for 20 years, only the company that produces Prilosec could produce and sell it because it was under patent. And then when it got close to 20 years, what that company did was they changed the formula slightly and reissued that drug as Nexium. Basically the same drug, a small change, but it gave them another 20 years for Nexium. Now, the rest of the world then, now that that patent for Prilosec is free, anyone can produce omeprazole. That's the generic name for Prilosec. So that came off patent. And that's one reason why Apple keeps reissuing the iPhone, not only to keep technologically current, but to keep a patent on the processor design. If you remember, Apple sued Samsung a few years back on a number of patent violations. They said they reverse engineered the Apple iPhone, and they sued Samsung. They won on some principles and they lost on other points. For example, the rectangular design. Apple said that's exclusive to them. Well, Apple didn't invent the rectangle, so they lost on that point, but they won on some other points. Now, when you develop, let's say Apple developed that iPhone internally. Remember, we said that when you develop a patent or a copyright or a trademark internally, we put that the cost of the labor involved or materials in research and development expense. We don't capitalize it. We don't put it in an asset account unless you buy it from someone else. If you bought a patent or bought a copyright or bought a trademark, then you would put it in a copyright or trademark or patent account. But if you develop it internally, you don't do that. You put it in an expense account. However, if Apple successfully defended its patent, their legal costs of defending the patent can be put into an asset account called patent. If you bought a patent from someone and you were sued or you sued on that patent and you lost the case, you would have to get rid of that patent account. If you lost the case, you no longer had an exclusive right. Just some tidbits on that. Technology assets include software, web development work. Most companies use intangible technology assets over just a few years because things change so rapidly with technology, right? So if you develop a website, the cost of developing it or paying someone else to develop it, if you're paying someone else, you can capitalize that. You can debit a technology asset account. But you're going to amortize that over a fairly short period because chances are you're going to want to change it up within a fairly short period. Technology assets tend to get used up sooner, right? We try to keep things current. Licensing rights are limited permissions to use something according to specific terms and conditions. Like, for example, at NCCC, we have the right to use the Microsoft Office products. And if you go to the IT department right next to Tim Hortons in the Learning Commons, they can help you or show you how to download Microsoft Office 365 for free. Why? Well, because the college made an arrangement for all of its students to have the ability to use that. It's part of a licensing right. And you have a licensing right too. If you're using a laptop, you have a license on maybe the operating system or whatever apps or programs that you bought for that computer. So those are called licensing rights. And again, you're going to amortize them over the length of time that you've paid to be able to use them. Franchises are also an intangible asset. This is a contractual right to sell certain products or services, or use certain trademarks or perform activities in a geographical region. Krispy Kreme donuts, the example you gave before, McDonald's, Burger King, any of those fast food chains, Applebee's, those are owned usually locally by someone, and they've paid the company for the ability to use that identity and process and product. Now, why would someone want to do that? Well, because you have an immediate audience or clientele, right? Because if people like going to McDonald's, then you immediately have name recognition. You don't have to build up a reputation. So what the amount that you put into, that you pay to buy that franchise, can be put into an intangible asset account, long-term asset account called franchise fees. And you would amortize that over the life of your franchise agreement. However, if the franchise agreement is renewable, you wouldn't bother amortizing that. It depends whether it's renewable or not. The franchise agreement is specific to each company. So each company decides what they want to put in it. Often you're forced to use buy the products from them, buy the hamburgers and buy the buns if you're McDonald's from them, to keep your building in a particular design, to have your staff wear certain clothes, just to keep the brand identity consistent between stores. But that all depends on the franchisor, the company that's selling the franchise, whatever way they want to do it. If you agree to that and sign on to it, you have to follow their rules. If you don't like the rules, you just find a different franchise. That's pretty much what it comes down to. Now, this last one, I think we talked about on the very first day briefly. So I'm going to kind of go back to the example I used the first day. That was Goodwill. Excuse me. So it says here, Goodwill tops the charts as the most frequently reported intangible asset. It encompasses lots of good stuff, like a favorable location, an established customer base, a great reputation, and successful business operations. Although many companies have probably built up their own goodwill, GAAP does not allow it to be reported as an intangible asset on the balance sheet unless it has been purchased from another company. So what do we mean by that? Well, let's say, and I think we used this example earlier, let's say I have a pizza business and I want to sell it. I'm tired of making pizzas, and I've got a great location, corner location, easy parking, great recipe, great wait staff, recognizable product, best pizza place in town, but I'm tired of making pizza. So I want to sell the business as a whole. Everything is, the business itself, all the assets included, including my great recipe. So I get someone in to appraise the business, and the fair market value of my assets are $1 million. That's how much the appraiser says the land, building, and equipment are all worth. But I know that I've got a turnkey operation. Someone can walk in tomorrow if they buy it from me and start business. Just open the doors and start selling the product to customers. They're going to be willing to pay more for my business because I have a good recipe, good wait staff, good location, good reputation, etc. So let's say I was able to sell it for $1.5 million. That means they're willing to pay me an extra $500,000. That's considered goodwill. Now, that's not on my books. My books have $1 million worth of the fair value of assets on them. But the person who buys my business will have $500,000 on their books. It goes on the books of the purchaser. This is why. Let's say when they buy my business, they go to do a journal entry and they debit land and they debit building and they debit equipment. Okay, so let's say the land is worth $100,000 and let's say the building is worth, $600,000, and the equipment is worth $300,000. That makes up the fair value of my assets. But they paid, let's do maybe mortgage payable. That's going to be for $1.5 million. Well, I've got debits of $1 million, credits of $1.5 million. I need another 500,000 here, right? To make sure the debits equal the credits. That debit is going to be to Goodwill. And Goodwill doesn't have a limited life, so it's not amortized. But what we do is test it for impairment. Remember, we talked about impairment a little bit. I said we weren't going to study it, but basically we're going to see if we still have that goodwill. Is your company still generating the rate of revenues that it had in past? Or have you changed your recipe and hired bad wait staff, and now you no longer have that goodwill going? The company no longer has a good reputation. We would test that for impairment. So it only goes on the books of the company that's buying the existing business. Any questions on that? No? Okay.
Will there be problems about this on the test?
No. On the test, the only thing you really have to know about intangible assets is what they are, be able to recognize them. They're long-lived assets that convey special rights that either come from law or by contract. And as those that have limited lives get amortized, which is like depreciation. And that's it. Just be able to recognize them. And if you've got that page available, let me just find it again. You just kind of make a few notes for yourself about which is what, so you can identify it when you see it.
Okay.
That's about it. The rules for SUNY on what they expect you to be able to do with intangible assets, is very limited. So yeah, nothing, no big deal, nothing like this. I just wanted to demonstrate that for you.
Okay, thank you.
Not at all. So this last thing is about the fixed asset turnover, and this would be the last thing on page 6 here, turnover analysis. But it's a little nicer to see here because it's a little bit bigger font and a little more colorful. So one of our goals in financial accounting is we say we want to be able to make good decisions about companies, both as investors and creditors. But as investors and creditors, you're going to want to know how well management uses long-lived assets to generate revenues. How good were they at using the land and building and equipment in order to run the business and generate the sales? And what we do to judge management is this fixed asset turnover ratio. We take the net revenue, which would be sales minus any returns and allowances and any discounts if you tend to give them. So say that would give you net. Remember, net means you subtracted something. So this would be sales less those returns and allowances and discounts. And you would divide by the average of the net fixed assets. And remember I told you they sometimes use the word fixed assets instead of long-lived tangible assets? This is one of the examples. What they mean there is things like land, building equipment, furniture, fixtures, vehicles, computers, that type of thing. And the reason why they say the word net there is that means the cost less accumulated depreciation. So the cost of the asset less accumulated depreciation. And then we're going to average those. You can take the beginning of the year, end of the year, add them together and divide by 2. I'll show you an example in just a minute. So what this ratio tells you is it indicates the dollars of revenue generated for each dollar that the company has invested in these net fixed assets. And a higher ratio implies greater efficiency. Now, if you're a manager, what you should do is, if you are not using long-lived tangible assets, you've got no use for them anymore, sell them, get rid of them. Don't keep them hanging around because they're going to end up in the denominator of that fraction. And the bigger the denominator or bottom of that fraction, the lower your turnover ratio is going to be. So if you've got assets that are just sitting around in your warehouse and they are on your books, if they are not fully depreciated, then you might end up having a lower fixed asset turnover ratio. If they're fully depreciated, then they're worth nothing. The net value would be zero. But if they're not fully depreciated and you know you're not going to use them anymore, sell them, because that way you can lower that denominator and increase the ratio as a manager. So let's take a look at 3 different companies here. We've got Cedar Fair, Six Flags, and Facebook. Now, Cedar Fair and Six Flags both have a lot of fixed asset investment in fixed assets, tangible assets, right? These roller coasters and different rides. So in 2015, we've got net revenue. Let's see, we're looking at 2015. We've got net revenue of, this is probably in millions. Yeah. So I'll just state them as they are, 1,235 million. And we're going to add together the end of 2014, the end of 2015, and then divide by 2. And that will give us an average. So add those 2 together and divide by 2. That gives you the bottom of the fraction. And then when you divide that out, the ratio for Cedar Fair is 0.81. We don't multiply it. It's not a percent. So we leave it in decimal format. For Six Flags, when we do the same thing for 2015, with the net sales revenue is the numerator, and then average out 1,200 and 1,220, which is 1,210. Add them together and divide by 2. 1,265 by 1,210 is 1.05. So Six Flags was more effective at using their long-lived tangible assets to generate revenue than Cedar Fair was. Look at Facebook. Now, totally different type of company, right? They don't have the roller coasters. Their investment is most likely in servers and technology. But look at their revenue dollars. Crazy, huh? And then there's their net fixed assets. We add them together and divide by 2. 3.71 is their turnover. So they're able to generate $3.71 in revenue for every dollar invested in long-lived tangible assets. Cedar Fair can generate 81 cents for every dollar invested in fixed assets, and Six Flags generates $1.05 for every dollar invested in fixed assets. So if you're an investor, this is one of the ratios you're going to take a look at to see how well management is using fixed assets to generate revenue. Okay, any questions about anything in Chapter 9 that you'd like to ask about? No? Okay, so the review for this is—
Sorry, it just cut out for like 5 seconds. I don't know what happened there.
Oh, what I said was, I asked everybody if they had any questions about any homework in Chapter 9, if you'd like to ask about.
Oh, I should be okay. Sorry about that. It just kind of cut out.
Yeah, no worries. I'm sorry. It could be mine. You never know. It could be my internet. Yeah. So this is not a doesn't have really complicated multiple choice questions where you really need to review the format. We'll go over the topics in a moment, but there are 12 of those. But there's one depreciation problem that features all methods. Now, we did 9-6 in class, E9-6. But then if you look at Chapter 9 in the Chapter 9 folder in Blackboard, there's a demonstration of E9-7. It's a very similar problem using all 3 methods. If you're rusty before you do your homework, and certainly before you do your test, if you're rusty on those depreciation methods, take a look at that problem demonstration. If you don't want to watch the whole lecture, just take a look at that problem demonstration, and that will go over those 3 methods for you, before you try that problem on the test. And remember, with the test, you can go in and out of it. You can enter it, work on it, take a break, come back to it later, just save and exit as you go. You can go in and out of it, so you don't have, it does not have to be done all at one time. So what's on the multiple choice portion? Well, the first one question is, what goes into the cost of a long-lived tangible asset? Well, if we look back, I'm just going to flip back to page 1 of our notes. We said, I'm going to scroll out a little bit here. That was that acquisition rule that we said was all reasonable and necessary costs to acquire and prepare the asset for use should be recorded as a cost of the asset. And then we gave some examples of things. So we call that capitalizing the costs. We mean debiting the asset account for those costs. So in terms of how to record it or journalize it, you actually did that back in chapter 2. Assets are on the left side of the accounting equation, so we left side or debit them. So if you buy land or building or equipment, we would debit those for all costs necessary to buy them and then get them ready for use. What do we credit? It depends. You might be making a down payment in cash. So if you're buying assets worth $10,000, you would debit that maybe equipment account, $10,000. If you have to pay $2,000 down, you would credit the asset cash, and then the other $8,000 you would owe, most likely on a note payable because it's a pretty big amount, but could be an account payable if you expect to pay it in 30 days, most likely a note payable for those long-lived tangible assets. So we debit the asset, we credit the liability, and if you have any payment of cash, we would credit that as well. That's kind of from chapter 2. Now, what about the difference between ordinary and extraordinary expenses? We did a problem the first day on this. So once an asset is ready for use, then if you have a cost related to that asset, you have to ask yourself what type of cost it is. Remember, any cost before it is used gets debited to the asset account. But once an asset is in use, you have to ask yourself, is this an ordinary thing I normally do? Like putting gas in the car and replacing the wiper fluids, changing the oil. Those are things I have to do all the time. I'm gonna have to do them again. Those are expenses because they only benefit the current period. So you would put that into an expense account, maybe repairs and maintenance expense. These are small, lower in value. They occur frequently. You're just keeping the asset in normal running condition. But if it's an extraordinary repair, replacement, or addition, we capitalize it. We add it to the cost of the asset. These occur infrequently. They involve large amounts of money, and you're increasing the asset's usefulness. How? Well, maybe you're increasing its capacity. We talked in that one example about the golf course, adding an addition onto the building. Or maybe you're modifying a machine to enable it to do a different process. You're modifying a truck, maybe with a tow area or some type of thing that you could attach onto it. That would get debited to the cost of the asset. Or maybe you're making it more efficient. It's able to perform its process more efficiently because you made this investment in the machine. Maybe you overhauled something on the machine. That would get debited to the cost of the asset. So these are things that you're going to benefit from over the time you use the asset. So we're going to debit the cost of the asset and depreciate that over time if they benefit more than one period. Any questions about that, the differences between those?
No, but I have a question about the double declining balance or either one of those methods. When it comes to like this right here, where the end doesn't balance out and you have to go in there and tweak it, I always get messed up on that part. Could you?
Sure. What you do here is you take a look the year next to the last year. So if it's going to live 3 years, you go to the end of year 2 and you look at what your book value is, your cost minus accumulated depreciation. You say, okay, that's where my book value is now. Where do I want it to be? Well, at the end of its life, we want it to be the same as the residual value. That's what we said it would be worth. So we look to see what the residual value is. And I think that was 2,500 there. Right. So just put it in there. Just write it right in and say, okay, so that means I need to make that go from 6,944 down to 2,500. So I'm just going to get out my calculator and I'm going to subtract 6,000. Oh, solar. So takes a moment. 6,944 minus 2,500. I find the difference, and that's the number I put for my depreciation expense in its last year. It's
Okay,
just a calculation.
so what will go?
Oops, you kind of cut out there. Pamela, I think I lost you.
All right, I'm sorry, I muted myself back.
No, that's all right.
So nothing has to go in the book value for the third year?
Well, it would automatically be the residual value. You're going to put that, just like it ended up 2,500 there, you're going to end up 2,500 here. You're going to put that number in rather than doing the calculation in the third year. Just write the book value there. The residual value there.
All right.
And just fill it in, and then you back into the depreciation by finding the difference between.
Go to the year before and
Right.
subtract the book value or the residual value.
Exactly. And
So you subtract the book value from the last residual. No,
Exactly.
I said it backwards. You subtract the residual value from the last book value.
Last book value. Yep.
Okay.
Those two. Exactly.
And then what's going to end up? Okay, and that's going to go your third year for depreciation expense.
Exactly. That journal entry, debit depreciation expense, credit accumulated depreciation. Yep.
So
And then that's the amount you're going to put in that account. So your accumulated depreciation is going to end up 60,000, like all the other methods.
All right. Okay.
Okay.
I think so.
You can always ask, you can always pop me an email.
I practiced that so many times with the tutor, and I'm still like, when it comes to it, I don't know, my mind scrambles on it.
Well, you can watch that little video too right before you do the test. Watch the video again, to kind of review.
Okay.
Depreciable cost. That's the cost of the asset minus the residual value. That's from page 2. The cost minus the residual value. In other words, that's the amount that you want to depreciate, is the depreciable cost. How to calculate book value or carrying value? That's cost minus accumulated depreciation. Book value is the cost minus the accumulated depreciation, also on page 2. What type of an account is accumulated depreciation? Okay, so that's a contra asset. This account is in the area of your chart of accounts as an asset, but it's a contra asset. It's going to be used to subtract from the asset the amount that it's worn out. So it has the opposite balance. It's got a credit balance instead of a debit balance. How to record the disposal of a long-lived tangible asset. Okay, so if you remember, this is where we debit cash for the amount that we're receiving, and then we do the opposite with the accumulated depreciation in the equipment account or whatever your asset is. If the accumulated depreciation has a credit balance, to get rid of it, we're going to debit. If the asset has a debit balance, to get rid of it, we're going to credit it. So we record the cash received and then do the opposite of the asset and accumulated depreciation accounts. Finally, we need to calculate whether we have a gain or loss. And to do that, we compare the book value to how much you're getting paid for that asset. In our example here, the book value would be 100,000 minus 60, or 40,000. And you got 50 for it. So that means you have a gain on disposal. If you got paid 30,000, then that would have been a loss. So gains are like revenues, they're credited. Losses are like expenses, they're debited. Okay, so that was. Oop, I lost you again.
I keep doing the wrong thing. So accumulated depreciation is like stockholders' equity?
No. It's like taking away from the asset the amount that it's worn out. So it's reducing the value of your asset. It's got a credit balance because that's how we reduce assets. but it's always shown with the asset account to remove from it how much it's worn out so far. Like the way we did with accounts receivable, we reduced it by the allowance account. This is reducing the asset account by how much we think it's worn out. So it lowers the value of our assets.
Mhm. Okay, so if you say a credit, then that means you subtract, you're taking from.
Yes, right, because assets normally, we increase them by debiting and we decrease them by crediting. So by crediting accumulated depreciation, it reduces that asset account.
Oh, that's so mind-boggling for me, those T accounts. Okay.
Okay, the fixed asset turnover, that's just the formula that we went over today. That's that one, and be able to just identify intangible assets. So if you open up that, that Connect book to page 411, it'll give you the listing of those long-lived intangible assets, and you can use those for reference. But this is a pretty straightforward test. I don't think you'll have any trouble with this one. Any questions that you have for me? Oh my gosh, I didn't realize how late it
I think
got.
I'm okay.
I am so sorry. I didn't realize how late it got. It's 10:54. So the homework is due on Wednesday at 10 and the test not till Wednesday night, and we'll start chapter 10 on Wednesday.
I came in late. Just wanted to let you know.
I'm sorry?
I came in a couple minutes late.
Oh, thank you for letting me know. Okay, I'll write you in right now.
All right, thank you.
Thank you. Was there anyone else?
Miss, can I talk to you after class?
Sure. Is there anyone else
All right.
who came in late that?
Yeah, I came in a few minutes late.
I
Thank
came
you.
in late.
Let me just say, who was the last one? I'm sorry.
Emma, sorry.
Emma. Thank you. Okay, perfect. I got you, Emma. Anyone else? No?